Warren Buffett calls it the best book on investing ever written. He says reading it at 19 changed his whole life. The book, The Intelligent Investor by Benjamin Graham. Most people lose money investing because they treat it like gambling. They chase hot stocks, panic when prices drop, and make emotional decisions that destroy their returns. This book teaches you to do the opposite, to think like an owner, not a gambler. And the first rule will completely change how you see the stock market forever. Today, I'm breaking down the 8 most important rules from The Intelligent Investor, the ones that will save you from costly mistakes and show you what it actually means to invest intelligently. Because here's the thing, getting rich isn't about finding the next Tesla, it's about not doing stupid stuff with your money. Rule number 1, ignore Mr. Market's mood swings. Let me explain this with a story that'll change how you see investing forever. Imagine you own a small auto repair shop. Nothing fancy, but it makes solid money. Regular customers, steady business. Every single morning, this crazy neighbor, let's call him Mr. Market, shows up with a wild offer to buy your shop. One day he storms in offering $2 million because auto repair is supposedly booming. The next day, he's dragging himself in, looking miserable, saying cars are going electric and he'll only pay $40,000. Then he changes his mind again, $800,000, because he heard people are keeping their cars longer now. Would you take this guy seriously? Of course not. You'd laugh and tell him to come back when he's sober. But when it comes to stocks, people listen to Mr. Market like he's a financial genius. Stocks go up, everyone's suddenly brilliant. Stocks go down, everyone panics and sells. Graham's point is simple. Mr. Market is emotional, dramatic, and usually wrong. During the 2020 crash, great companies like Microsoft and Apple got way cheaper, not because they became bad businesses, but because Mr. Market was having a meltdown. The smart investors didn't panic. They saw opportunity. Your job isn't to predict where prices go next week. Your job is to know what you own and only act when it makes sense. But here's where most people mess up completely. Rule number 2, know the difference between investing and gambling. Here's the brutal truth. Most people think they're investing when they're really just gambling. Investing is calm, thoughtful, long-term. It's like buying a house you plan to live in. You check the neighborhood, the schools, the foundation. You're not buying it because the price might go up next week. Gambling is buying something just because your barber said it's going to the moon. No research, no understanding, just hope. Real investing means 3 things. You do your homework on what you're buying. You protect your money from permanent loss. You expect reasonable returns, not 10 times overnight. Let me ask you something. If I offered you a piece of a pizza shop you've never seen, don't know the owner, no clue if it even sells pizza, would you buy it just because I said it's going to blow up? But people do this with stocks every single day. During the dot-com bubble, people threw money at anything with .com in the name. Didn't matter if the company had 0 revenue, prices skyrocketed, then everything crashed. Graham's rule, treat every stock like part ownership in a real business, because that's literally what it is. Now, here's the one rule that could save you from losing everything. Rule number 3, always have a margin of safety. This might be the smartest thing Graham ever taught, and almost nobody talks about it properly. Don't pay full price for anything, especially stocks. If you're building a bridge for 10,000-pound trucks, do you build it to handle exactly 10,000 pounds? Hell no. You build it for 30,000 just in case. That extra strength is your safety margin. Same with stocks. You figure out a company is worth $50 per share. You don't buy it at $50 or even $45. You wait until it's $30. That $20 gap is your safety margin. During 2008, solid companies were trading way below their real worth just because people were scared. Warren Buffett was buying like crazy because of that huge margin of safety. Here's what people always ask. What if I love a company but the price keeps going up? A great business at the wrong price is still a bad deal. You don't chase, you stay patient. You wait for Mr. Market to throw one of his mood swings, and trust me, he will. This next principle is something 90% of investors completely ignore. Rule number 4, understand what you actually own. Most people buy stocks without having any clue what the company actually does to make money. You need to understand intrinsic value, what a business is actually worth. This isn't about complex formulas. It's about common sense. Does the company make money? How much? Is that number growing? Do they have competitors breathing down their neck? Are they in a dying industry? If you can't explain what a company does and how it makes money in simple terms, you shouldn't own it. Warren Buffett won't invest in tech companies he doesn't understand. Not because tech is bad, but because he knows his limits. Stay within your circle of competence. There are thousands of stocks out there. You only need to understand a few really well. The market will constantly try to distract you with the hot new thing. Ignore the noise. Focus on businesses you actually understand. But here's where it gets controversial. Even Buffett breaks this next rule sometimes. Rule number 5, pick your strategy and stick to it. Graham splits investors into 2 types, and you need to pick a side. Defensive investors. You don't want to babysit stocks. You buy broad index funds like the S&P 500. You invest the same amount every month, whether the market's up, down, or sideways. You check your portfolio maybe once a year. This is how most people should invest. It's boring, but boring builds wealth. Enterprising investors. You love digging into businesses. You read financial statements for fun. You hunt for undervalued stocks like a detective. If this is you, cool. But know that it's serious work and it's not for most people. The dangerous middle ground is where people get destroyed. Picture this: the guy who buys Tesla on Monday, sells it Friday when it drops, then panic buys index funds the following Monday. That's not investing. That's financial whiplash. Graham was clear: if you don't have the time, skill, or interest to research properly, be defensive. There's no shame in index funds. They've made more millionaires than hot stock tips ever will. Now, this next rule might surprise you. Rule number 6, don't put all your eggs in one basket. Even Warren Buffett, who's famous for concentrated bets, understands diversification. You never know which individual stock might blow up, and not in the good way. Remember Enron, WorldCom? These were huge, safe companies that went to zero overnight. Diversification isn't just owning different stocks, it's owning different types of investments. Some stocks, some bonds, maybe some real estate, different industries, different company sizes. This doesn't mean you need to own 500 stocks, but don't bet your entire future on 2 to 3 companies, no matter how much you love them. The goal isn't to maximize returns. The goal is to avoid catastrophic losses that you can't recover from. You can survive bad returns. You can't survive losing everything. Rule number 7, inflation is your silent enemy. Here's something most people ignore. Inflation quietly steals your wealth every year. If your investments return 5%, but inflation is 3%, you're really only making 2%. Your money is growing, but your purchasing power barely improves. Here's a concrete example. If you have $100,000 in safe savings earning 1%, while inflation runs at 3%, that money will only buy $100,000, $82,000 worth of stuff in 10 years. Graham understood this decades ago. Your investments need to beat inflation, or you're getting poorer in real terms. This is why keeping all your money in savings accounts is financial suicide. Sure, it feels safe, but you're guaranteed to lose purchasing power every year. Stocks have historically been one of the best inflation hedges. When prices go up, companies can raise their prices too. Don't just focus on returns, focus on real returns after inflation. And here's the final rule that separates winners from losers. Rule number 8, master your emotions, or they'll cost you everything. Your emotions are your biggest enemy when investing. Not market crashes, not bad companies, your own brain. Graham was clear. The difference between successful investors and broke ones isn't intelligence. It's emotional discipline. We see this constantly. Market drops 5%, everyone acts like it's the apocalypse. People panic sell, or some random stock explodes overnight and FOMO kicks in. Here's what emotional decisions actually cost you. If you panic sold during the March 2020 crash and missed the recovery, you'd have lost over 50% of potential gains. That's not a small mistake. That's life-changing money. Markets will go up and down for no logical reason. Your job isn't to control the market. Your job is to control yourself. How? Have a system. Dollar cost averaging, rebalancing. Rules you follow regardless of what's happening in the news. When you have a system, you don't make decisions based on panic or hype. You follow the plan. How this all works together. Look, these 8 rules work best as a complete system, not individual tips. First, you treat stocks like real businesses, not lottery tickets. Every time you think about buying something, ask, would I be happy owning this for 10 years even if the price didn't move? If not, skip it. Second, you protect yourself with margin of safety. Don't chase stocks when they're running hot. Be patient. Wait for prices that give you a cushion, not a heart attack. Third, when Mr. Market throws his tantrums, you don't join the drama. Sometimes the best move is doing nothing. Fourth, you pick your lane. Index funds if you want simple. Individual stocks if you want to do the work. No middle ground. Fifth, you diversify enough to avoid catastrophic losses, but not so much that you own everything. Sixth, you remember that inflation is always eating away at your returns. Your investments need to keep up. Seventh, you build systems that remove emotions from the equation. Automatic investing, regular rebalancing, ignoring daily noise. Finally, you stay disciplined. This is what separates winners from losers. The beautiful thing about Graham's approach is that it protects you from yourself, from hype, and from market madness. Most people lose money because they can't follow simple rules consistently. They get emotional, they chase trends, they panic at the worst times. If you can avoid those mistakes, if you can think like an owner instead of a gambler, you're already ahead of 90% of investors. The market will try to shake you out. Financial media will try to scare you or make you greedy. Your friends will brag about their latest sure thing. Ignore all of it. Stick to the system. Let compound interest do its work. That's how regular people build real wealth. Not through hot tips or market timing, but through intelligent, disciplined investing over time.